welcome. My name is Brandon Wendell and I'm a Master Instructor with Online Trading Academy. Today I want to talk to you about how to identify the potential for a bull or bear market using longer term charts. One of the things as investors we want to know is, are we ready to buy into the right market? We obviously don't necessarily want to buy into a bear market as prices continue to move to the downside and we start having losses. We do want to buy into bull markets as prices are typically going to be moving to the upside and giving us a nice return in our investment. One of the things we can do is look to the broad market or the Nifty index to get an idea of how the markets might be if they are shifting to a bullish or bearish market. Now, two of the indicators that I will use are simple moving averages on price. Looking at my chart, you can see right now that I have both a 40-week simple moving average and an 80-week simple moving average, both on the Nifty. Well, why those particular moving averages? Because in studies I've done throughout the world and looking at major indexes, they seem to work very, very well, and especially on the Nifty. They will help us identify when we are entering into bullish or bearish markets. First of all, the 40-week moving average is very similar to, well, pretty much is almost the same thing as a 200-day moving average, which is something that institutions like to use to identify bullish or bearish opportunities. If we're bouncing off of that to the upside, you can see that those may be buying opportunities to accumulate more stock in this bullish market. The 80-week moving average is very interesting though. Notice right here, we finally had a close below the 80-week moving average. Well, going back in time, the last time we had closed below the 80-week moving average was all the way back, if I can scroll back my charts here, there we go, in 2009. That's the last time we had a weekly close below that moving average. Overall, in this entire bullish run, you can see we never once closed below that moving average. So overall, when we are trading, we can see that if the Nifty is bouncing off the 40-week moving average, that gives us an indication it may be time to buy. However, we break down, watch for the warning of a close below the 80-week moving average as a potential sign for a change to a bearish market. Let's take a look back, and I'll go back here in time to 2007-2008 and take a look to see if this system could have given us an early warning or at least some warning to avoid some of the dangers of 2008 and the market's decline. Here we see we had a massive decline in late 2007. Prices initially bounced off the 40-week moving average, shuffled back and forth and bounced off the 80-week moving average as a support level, went up to the 40-week, but notice it used it as a resistance area before closing below the 80-week. Had you simply exited either at the touch of the 40-week moving average where it worked as resistance, or exited your investments as the market, the Nifty, closed below the 80-week moving average, look at all that pain you would have saved yourself. And if you waited until the market closed back above the 80-week moving average, if you notice, you actually bought in just slightly lower than where you exited the market, and you missed that entire move down and much of the move to the upside, but you were still able to participate in the remaining bullish trend to the upside. So overall, we can look to these moving averages, and even going back in time, you can see the last time we were below the 80-week moving average with the close was in 2003. Using this system, you would have been able to buy in 2003, hold through the entire 4 years up to 2007 into 2008 when the markets finally went bearish, and then finally participate in the most recent rise up in the markets to maximize your potential profits. Now, one more thing about these moving averages, typically when they cross over, that confirms my trend reversal. A close below the 80-week moving average would be a sign for me as an investor to exit out of my long positions in the market as the markets are turning bearish. If the 40-week moving average crosses below the 80-week, I now have confirmation we are in a bearish market and may seek alternative investments rather than trying to be long in the stock market. Once the 40-week moving average crosses above the 80-week, as we see over here, that now tells me it is safe to buy long-term stocks and profit from the upcoming bullish market. So overall, what we need to do is stay safe when we are trading and look for warning signs the market is turning against us as investors. Well, Until next time, trade safe and trade well. My name is Brandon Wendell with Online Trading Academy. I hope to see you soon.